for the Australian DeFi Association. And I would like to acknowledge the traditional custodians of the land on which we're meeting today, the Whadjuk Noongar people, and pay my respects to their elders, past, present and emerging, and acknowledge that sovereignty was never ceded. This always was and always will be Aboriginal lands, and there's an important date coming up on the 14th of October. If you haven't already voted, make sure that you get onto that ASAP. Welcome to the October meetup for the Australian DeFi Association. So we are a community group, non-profit educational community group for the DeFi, blockchain, crypto, Web3 community. So welcome people from Perth. Today we are going to hear from someone really special, Egor Sidelska from Magnet Capital, who's over here from Sydney. He will be talking about learnings of a crypto asset manager in just a moment. We're going to do a few updates and you'll hear from our co-founder Mark Montfort in Sydney, who's got a little video message. Then we'll have some Q&A, we'll open it up to the floor. We've only got one mic, but I'm sure everybody can project. And then this will wrap up at around 8:30. Feel free during the course of this thing, even though there's a mic and a screen, it's pretty informal. We are a community. You're welcome to go up, charge your glasses and get some pizza along the way to fuel up. A bit of admin, and this is something that I've realised, notwithstanding that this is the 9th time that we've done this now, I've never told anyone where the toilets are. They're really important. So it turns out there's 2 places, just there, and where he pointed. So if you do feel that you need to visit them, that's where they are. What else? All the usual meeting etiquette, phones on Do Not Disturb, please. You're welcome to take photos and videos, like tag us. We're on Twitter. If you don't have it, I think it's OzDeFi on Twitter. Okay, so who are we? I'll give you a bit of an intro. Many of you are new. So the Australian DeFi Association is a community, as I said. We're a non-profit peer-to-peer education platform started in December 21 by a group of DeFi curious people in Sydney around a bar that started into a WhatsApp thread, exchanging materials that grew into what is now our Discord. And that has grown from a community of about 20 people in Sydney to over 2,000 people around the country. We have 7 cities that are now involved, over 2,000 people on our socials and our Discord. In Perth, we set up last July, so I'm originally a Perth girl, but then moved to Sydney, came back last year. There were 5 of us at the Petition Hotel, and now we have anywhere between 25 to 50 people coming to our events, so thank you very much for being part of that. And DeFi, as you may have noticed, is a bit of a misnomer because it's more than just decentralized finance. It's also generally crypto, Web3, NFTs, and many other things that are related to the blockchain and digital assets. So we not only do meetups, we also do media. Our co-founders Mark, Arturo and Nick are often on AusBiz talking about crypto and the trends there. We've got a podcast, newsletters, and we also get quite involved in regulatory consultations and engagements. You're welcome to join the Discord again with the QR code. And speaking of Mark, we're just going to hear from Mark for about 4 minutes. He's got a broad update on what's happening nationally and internationally, and hopefully you can hear him from my laptop.
Hey guys, it's Mark here from the DeFi Association, the president of the group and one of the co-founders, and just wanted to say thank you again for coming along to another event here in Perth where you're listening to this. Led by the awesome Kat Dunn, the crew of Bamboo, and many of the other supporters. This month we've got Egor over from Magnet Capital and anyone else that might be over from that crew. We know those guys from Sydney, so they are doing some amazing things in the Web3 space and investing. Just wanted to give you guys a quick rundown and update. It's been an amazing last couple of weeks since we've last seen you. There was the events last month in Perth. Arturo and I, one of the co-founders, we were over in Hong Kong, then Singapore, and then I headed off to the Philippines. So I was there for Token 2049. There was a whole bunch of other Aussies in the space. We wrote about it in our newsletters and on my personal blog, as well as my work blog for Not Centralized, the company that I work for. Arturo and I were really proud to represent the Aussie community and see what is going on in the Web3 space and as well as AI over there. And it's really amazing to see the government, the startup, the community support. There were really great events. Philippines has a lot of fanfare. There's a lot of dancing, as you can imagine. I'm Filipino, so it's really great to be in my hometown. And it was really great to see what is going on outside of the little bubble that we have here in Australia. There's a lot of lessons there. For example, that we're really comfortable in terms of how we're doing things here, not just in emerging technology, but just in any tech that's disruptive. We've got a really great market here. Regulation is really good. It means that there's higher hurdles to overcome because we're comfortable. But when you go to countries where there's been a lot of changes going on, you see things in the Philippines that you just don't see here. You see these digital asset kind of banking and payment providers that do everything from trading to sending money to each other to even paying your bills. And it's all done by QR code. So there's things like Gcash and Maya. So there's definitely lessons that we can learn about there, some really innovative stuff. And they've been forced to just to be able to keep up the pace. Whenever you have new technology that comes out, it's always the tail ends that end up doing things first. So the tail ends being those that have money on the one side and those that don't have money on the other side. The comfortable middle usually does lag, but because you're in this space, because you're at this event here in Perth, you're definitely one of the top tier, the people that are early, the adopters, the ones that want to see change. So thank you very much for coming along. We've got a whole bunch of other events going on in the Web3 space. By the time you're listening to this, I think it's the 12th, tomorrow, actually no, not tomorrow, next week, there's going to be a whole bunch of events. South by Southwest here in Sydney, we're running some Oz DeFi events then. Some of our friends are also running events, so Blockman has got their event with Synthetics. There's also stuff going on with Algo Hub, Stables and BitGet. There's a whole bunch of other stuff going on as part of and as aside to South by Southwest. So that's really amazing. And then after that, you've also got the Oz CryptoCon going on over in Melbourne, and that's going to be later in November, or the early weeks of November. Just a bit before that, it's Blockchain Australia with their Blockies Awards. And then later on, we've got the Crypto Assembly here in Sydney, and we're supporting that. So a whole bunch of events coming up. We really look forward to it. Hope you can make it over. But otherwise, we're really proud of our community over there in Perth, and we thank the folks at SpaceCube for providing us this awesome space. I hope you have a great networking event. You have some great talks, great ideas shared, and remember, the key thing about all of these events is that you make some connection. You walk away with something, some new LinkedIn connection, WhatsApp, whatever it is that you just connect. Bring your mates next time and just continue to grow that community. Really proud of what you guys are doing there, and we'll see you soon.
Thanks, Mark. I don't know if everybody was as distracted as I was the first time I saw this with the fat beats in the background. He's Filipino. Forgive him. Okay, wait. Hold on. Oh, God. Oh, God. No, stop. Go more right. Yes. Okay, cool. So that's what's going on around the country and internationally. In particular, Perth. So I have a towel. I just noticed that I had this. We originally started out in July with 5 of us, and it grew in like September to 7, to then a wacky 11 in October, and now there's 25. I have to thank our sponsors who've made that possible. So SpaceCube has been kind enough to give us this pretty awesome venue. Blake and Tracy from Bamboo, who started sponsoring us this year, and we also have Ronan from H-Bar Suite, Aviatrix SDG, which is my organisation, and Magnet Capital in particular for today. So thank you to our sponsors and everyone that comes on the reg to help, in particular Lauren and Sophie and Phil, James and Jacob, who's helping out with the content. We're starting to grow a really cool community, and everybody pitches in. So thank you so much, guys, for making this a really kind of team event. So this is our 9th meetup since inception. Normally we have them every month, but next time in November, December, we're gonna have a bigger thing with West Tech Fest, so stay tuned for that on the meetup and also on our Discord and Twitter and LinkedIn. And Mark alluded to it, but we are lucky enough to have the PR manager for the Oz Crypto Conference, Lauren here, who's also a really engaged community member. who will just tell you a little bit about what you can do to get involved and, yes, when it's on, what it's all about. Lauren.
Hi guys, yeah, I'm Lauren, PR and Events Coordinator for CryptoCon. It's going to be on in Melbourne on the 11th and 12th of November. And yeah, we're really happy to sponsor with DeFi Association. They always do super good work, and yeah, just really happy community to be a part of. So yeah, we want to give back, and I know it's kind of far to get to Melbourne, so I know not everyone will be able to make it, but just wanted to make it a little bit easier. And we're giving away some free tickets through DeFi for the event in November. And this is the code here, DeFi free. So if you put that in at checkout, then you can get some free tickets to attend, which is. Oh, sorry guys, a bit late. So hopefully we can see some of you over there, and it will just be a really nice time. It's 2 days, and everyone under the same roof, and lots of side events, lots of networking. Yeah, so it'll be a really nice time.
So Lauren, we just put that in on the website and we book a ticket?
Yeah, just at the end, the little code. Alright, thanks guys.
You know, one way you could structure that, Murray, is to sell your ticket to a non-member, and then... Oh, who was that? I didn't say this. Oh, Phil, sorry. I misattributed. But you could also do that as well, 100%. I don't understand.
It's not an NFT ticket.
Okay, so... thank you very much. We'll have another opportunity to do that at the end, because we'll have the QR code as well for those who are interested in going. So we've had quite a few different events the past few months. In July, we had Mark Montford, who you saw on the video, come over here from Sydney, give us a live update on what's happening in DeFi and crypto around the country. In August, we had the F-Off event where Blake and Ronan and James shared some of their challenges and lessons in being builders in the DeFi space. And then last month we had a collab with the UWA Blockchain and Cryptocurrency Research Centre where they shared some of their research. And today we're going to be hearing from Egor at Magnet Capital, who's going to be talking about investing, the decisions that you made, and some of the trends that impact your portfolio, and some lessons that we can learn from you. And so before we do that, I'd love to introduce Egor. He has a background in computer science, started mining Bitcoin and Litecoin in 2013, and launched Australia's first crypto hedge fund in 2017. The fund runs a high conviction, long-only strategy focused on infrastructure, DeFi and meta assets. Magnet runs validator nodes, stakes assets, participates in DAOs, and helps founders bridge the gap between CeFi and DeFi. Everybody, please give it up for Egor Sidelska, the co-founder of Magnet Capital from Sydney.
Hi everyone, thank you so much. Great to be here. So what I'm going to do is a little bit different to probably most of the other fund managers, or actually most of the other presentations that you would have seen. I'm going to tell you what I'm not going to do first. So I'm not going to teach you about crypto just by sheer virtue of you guys being here. You probably already know what it is by attending an event called DeFi. I'm not going to teach you how to trade. Number one, we're not a trading fund. Number two, it's probably not why you came here. And I'm definitely not going to teach you how to invest. If you're already here, then hopefully you understand what crypto is. Therefore, what I'm actually going to do is share my journey. So I'm going to share the journey of Magnet Capital. I'm going to share some of the mistakes and learnings so that you can laugh at me. So that you can hopefully and maybe not make the same mistakes that I have and my firm has. So who are we? Just a quick bit of background. I will unpack all of these so that I can move around. So we were founded in 2017. As mentioned in the bio, appreciate it. I started mining Bitcoin and Litecoin in 2012, 2013. That became incredibly unprofitable very quickly. I've got some very funny stories about that over some beers. We shut off the power to our street. We got a £11,000 electricity bill from the provider. So as you can imagine, kids back then didn't know what we were doing. Very, very bad. We became the first licensed hedge fund in the space by acquiring a corporate authorized representative license in 2017. That took thousands and thousands of dollars. We didn't need to do that, but we wanted to because we wanted to be the institutional investment manager in the space. We launched the first ever Ethereum fund. That Ethereum fund turned into a native staking fund. We can do that because we have a license. We bootstrapped all the way from 2018 to 2019, which was the longest bear market that we've seen. We nearly died. That's a good story. Throughout all of that, the returns chart is on the right-hand side. We are the green line. Since inception, we've returned 23% IRR over 6 years. More importantly, we've distributed 130% of capital to investors, which means if you started investing in our fund with $100,000, we would have given you back $130,000 while keeping your existing investment in the fund. We raised money into the manager. Unfortunately, when you are two guys in your late 20s, early 30s trying to become an institutional asset manager, you get laughed out of a lot of rooms. So we brought in grey hair. We brought in people like Mark Nelson from Caledonia, who you guys might know. He runs a $14 billion hedge fund for the Darling family. We brought in Marcus Freeman and Alex Unsworth from Canaccord, the fourth largest investment bank. Matt Rockman, who's a particular character, has like 6 boats. He's the ex-co-founder of Seek, and then some other high net wealth families. We have survived 2 bear markets. That's quite interesting. I've personally survived 3. That's why I look so old. And we write research monthly. So it's all public. It's all available. It's all on our academy on our website. So let's get right into it. I call this Mistake Memoirs because over the last 6 years, periodically I remember the same feeling that I get in my chest where I hate this space so much and we've made all of the mistakes and then I have to write it down. So these are just some of the funny ones that I've picked out of there. It's like 4 pages, by the way. So anyone thinks that you've made mistakes in the space and lost money, come and talk to me. I bet I can beat your story. So the first one is about new narratives. There's quite a few here. There are always new narratives forming around crypto, whether you started in 2016, 2017, if you remember Bitcoin forks, if you remember ICOs, the ICO boom where you could have invested in anything and made money. L1s, DeFi, stablecoins, all of these are brand new narratives that attract new users into the space. They basically are a reason for existing. Then there are some shit narratives. Meme coins, okay. Food coins, yield farming. Did anyone remember yams? Yeah, okay, yams, yeah, they're terrible. STOs, IEOs, airdrops, all of these are new ways of bringing in new capital. And then market driving narratives. So whether you like halving cycles, whether you're a macro investor, whether you believe in on-chain metrics, whether you're a momentum-driven investor, the beauty with all of these is you can actually make money across any of them. If you study deeply enough, you can make money on NFTs, you can make money on liquid staking derivatives, you can even be an airdrop farmer and make money. What you can't do is what we did, which is all of them, right? So what you can't do is you can't say, actually we believe in halving cycles and we like some of the mission statements, but we don't like all of the mission statements. And we are very highly correlated, but also we really like L2s in gaming and NFTs and some DeFi. And we don't really like other layer 1s because we really only believe in Ethereum. And we don't like meme coins because we're too good for that. And definitely don't like food coins. But yield farming serves some purpose. Yield farming is okay, we can justify that. And security tokens are great and they make us feel important, so that's why we invest in those. And I don't really understand IEOs, but sure, airdrops are free money, so we'll do that. Okay, so you can see that if you do this strategy, you end up doing nothing. You can't do anything well. So don't do like us and be this guy here, which is actually a cartoon copy of me. Don't do that, right? Pick something that you feel that you have a competitive advantage in, or you feel that you want to do the research in, and stick to that. Typically, it's 1, 2, or max 3 of these things. The problem with narratives is by the time that narrative actually forms, it's towards the end of its life cycle, it's towards the end of the timeline. By the time that you feel that there's value in this new narrative that's building, it's already too late. But by sheer virtue of people talking about that investment structure, people talking about that hype, you're towards the end of the bell curve, which means you have a very, very short window in order to make money, because as a fund or as an investor, that's your key principle. You're typically towards the end of that. Moving on. Guilt. I don't know if, just as a show of hands, who has ever invested somebody else's money? Okay? Who's ever had a friend that's come to them and say, what should I invest in? Or what's the, okay, right, okay. So most of you will feel that, who's actually given that advice? Like, hey, you should buy this, you should buy Dentacoin or whatever. Qualified advice. Yeah, no one has ever given any advice. Let's just be very, very clear. Okay? Good. Guilt is very real. Okay? In the beginning, your investors, your key investors, are the 3 Fs. This is very common. Your friends, your family, and fools. They're the only ones that will entrust you with their hard-earned cash. And you will lose money. Guaranteed you will lose money. Some of the best traders that we know, they trade on 51.49. 51.49 is they win 51% of the trades and they lose 49. The difference in how you scale is the 51% is orders of magnitude more in value than the 49. So you might lose that, but you lose less value. And that's effectively how you trade and make money. So the one thing that I can guarantee you is 100% you will lose your friends and family's money. And when people ask you, all of the people that put their hands up to say yes to their friends or their family or whoever asking them about when the right time is to invest, or what token should I buy, or when should I get into this market, the problem with this is it's a lose-lose. It's a lose because if you get it right and you actually make the money, they're like, well, obviously, you work in the space. So that's why I asked you, because I want to make money. Yeah? Obviously I make money. Anything other than that is still a loss, because if they make no money, they're like, what the fuck? Where is my money? And if they, even worse, if they lose money, they're like, you're an idiot. Why did you tell me to invest in Dentacoin? Obviously the dentists are not going to use it. I can see that now. So it's a lose-lose, never do that, right? The best thing you can do is educate people, because still to this day, I've only seen a very, very small, probably public people, but no one personally, that spends anywhere near 10 to 15 or even 20 hours researching and going deep into crypto, coming out the other end and saying, actually, you know what? I was right the first time, it's full of shit. Right? It almost never happens, but people don't spend the time. So educate them, don't give them advice. Emotions make bad decisions. If you have guilt, the guilt keeps you up at night. The guilt drives you. Fuck, I should have never told Steve to invest his last 10 grand. Right? He has a baby on the way. He really needs this $10,000. I really want to make this investment. But Steve, okay. Bad decisions mean bad returns. Bad returns means you lose more money. And you start the cycle all over again. So whether you manage money for yourself, whether you're managing money for other people, whether you're helping your friends, just know that you will lose money and that you'll start the cycle over again. So if you can sleep at night with high conviction, knowing that you're going in the right direction, you'll be okay. Every other time, don't do it. Do you know what loss aversion is? So loss aversion is basically the people are more scared of losing money than they are of not making basically double. So they are double as scared of losing a single cent than they are of not making any money at all. That is absolutely crazy. We have a case study where one of the richest families in Australia invests with us. They invested very, very early on. They made a ton of money. Bitcoin pulled back, and they redeemed. They redeemed not because they were nervous about their initial principal. They still believed in Bitcoin. They redeemed because they saw a red line in their item. Loss aversion is crazy real. If you can't handle red line items, this is definitely not the market for you. The problem with line items is this is a market that never closes. Equities closes, right? Bonds are regulated. This is a market that never closes, 365. Imagine if you ran a VC firm and your VC firm financials of every portfolio company were publicly available to anyone and ever. And every single person could trade off that information. You would have the craziest volatility, and that's why they don't do it. Tax. Okay. Tax is a really great way to lose lots of money. Let me explain why. Scenario 1. You found Yield Guild games. Okay? You buy Yield Guild at $2. Over 2 months, it 5x's to around about $9 or $10. You're a genius. Well done. You're all an investment manager now. So what do? Okay? You have this very real scenario where it's taking you 2 months to turn whatever amount of money 5 times more than you had previously. Do you sell it? If you sell, you incur a 50% capital gains tax. Profits in the fund, right? So unit trust structures as well. Unit trust structures make up the majority of funds in Australia. A unit trust has to distribute profit. Therefore, if you're a manager like me, you get a 50% tax bill, you have to distribute that out. You effectively push money out of your fund every single year. So let's give you a hypothetical scenario. You've got $100,000 invested, $400,000 in gains, of which $200,000 has to be pushed out. So you're sitting at a $9 or $10 asset price, and you go from your 5x into a 3x, simply because you have to incur the tax penalty and you have to push that tax out. So, do you wait for the discount or not? At 12 months, you get the discount, right? At 12 months, you half that 50% into 25. So what do? We waited, obviously. Yeah, we waited. We waited for some. Now it's down to $4, okay? Now it's down to $4. Your $100,000 now has $100,000 in gains. You've effectively turned your 5x into a 2x. But you've only got 5 months to go, right? Only 5 months to go. Come on, you can hold up. If you only got 5 months to go, you can justify the position as to why you want to hold, or you can justify the position as to why you want to sell. In this case, if you hold, you turn your 50% profit into 75% profit. Remember, we're here for absolute returns. We want to drive IRR. 75% over less than 1 year is still pretty fucking good. Right? Okay, so maybe not. Yield Guild Games is now worth 20 cents. Okay? So definitely the wrong decision. So, if you think you're way smarter than I am, which you probably are, we're going to play a game. You're going to be the CIO. We're going to play a real life scenario out for you. Okay? You are the CIO of Magnet Capital. You invested in an asset that is worth around about $50, sometime in April, end of March, start of April. You've done really well. The $50 has gone up to 300, back down to 200, is normalized somewhere in the middle. So what do? Any takers? What do? Buy, sell, hold. Sell? Okay, yeah, clever, yeah, smarter than me, okay. Right, so you sell 50%, it's now stabilized and going up. What do? You like the asset, by the way. It's not like, this is not a food coin, we're not talking about yams here. This is you've done work here, you're a professional investor, you're a CIO, you're a licensed fund. Okay, what do now?
Sell everything for 2017.
Okay, don't cheat. And I've got you, by the way. Sell everything.
You've locked in your tax liability, so now you're only going to be tax liable for any upside.
So you're lowering your overall risk moving forwards.
Well, what did you sell before? 50%?
Yeah.
Yeah, okay, so you're 50%, so you've locked in a 25% gain because the first thing that comes out is your principal, then it's your profit. So let's call it whatever. So you've got a 50% capital gains tax on half of the asset, right? You've got 50% left. What do you do from now?
Gamble. Well, I mean,
Okay, you can hold it. Yeah, you can hold it. You can hold it. Okay? Well done. Okay? You held it. So now you have to pay 50% capital gains tax on something that has gone up from $50 to $800. Okay? Good investment decision or bad investment decision?
If you take your initial investment out, then you're not paying any tax on top of it. So anything on top of that is your.
On paper, sure. Yeah, on paper, you can do whatever you want. Yeah. So you've taken your initial principal out and you've paid tax on that. If you kept it in, you would have made 10 times more.
If it's your initial investment, you're taking out what you put in, so you're not paying tax on top.
But you took out 50%.
greed is the biggest tax of all.
Sorry?
Are you incorporated in Bermuda?
No incorporation in Bermuda. No incorporation in Bermuda. We're Australian-based fund. You pay Australian taxes.
Greed is the biggest tax of all.
Okay, so what do you do now? You still have 50% of the asset. What do you do now?
You lock in, profits locked in is better than profits potential.
So you sell. You sell now.
So now we keep it.
Okay?
What's your mandate?
Well done, you sold. Mandate is absolute returns. It's the same for every single fund. Okay, well done, you sold. So you sold 50%, you missed the peak, but you sold the other 50%. By those paying attention, you would have probably known the story. This is what happened to the asset, okay? You still like the asset, okay? As an investment manager, you are now completely out, given the consensus. You made some money, you paid some tax, you're completely out. What do you do now?
Start rebuying.
Do you start rebuying? You just sold the asset for a profit. Do you rebuy? Look at the chart.
If you like the fundamentals.
Okay.
Diversified allocation.
No, just the one asset. Just talking about the one asset. What do you do in this case? Do you leave it alone and you go back to it and you call the win, you pat yourself on the back, or do you rebuy this same asset?
It depends why you like it in the first place. Was it like a contextual reason or?
Okay. Yeah, good questions. Yeah. So the key principle is whether you missed your little uptick or not. If you have high conviction in the asset, there will be another time to rebuy. Now, some will rebuy here because of FOMO. It's easy to look in hindsight, but when you've got an asset that you absolutely love and you've sold it here, and then it does this, you feel this inanimate need to go back into the investment because you're like, fuck, I knew it. I knew this was going to be the one. This is what I said from the beginning.
I have a question. Did you model what the actual valuation should have been at the time, or was it?
I mean, you'd struggle to model what any valuation would be at the time.
Well, because at any point, like you can have a look at any asset and go like, well, why is it increasing in value? You can usually see like a stack of either in any revenue coming in or some external contextual situation creating value. And then if the value, that is the asset price, does not match what is happening outside of it, then there's like there's a gap, right? And so you'd be like, well, it probably would be not that value, but this value if all of these external things held true at the time.
Sure. And that's a very sound investment principle for private equity and venture capital and equities. In crypto, none of those metrics make sense. It's like, hey, the thing has gone up 5 times in 1 month. How do you justify that? I have no idea. Have you seen the Solana chart?
Yeah.
Like, you bought Solana at $2. I would say 90% of people sold it at $40. It went to $280 with virtually no retraction. So like, the metrics make a lot of sense, but when the music's playing, you have to keep dancing. Okay, so I'll tell you, you're all very smart investment managers. Show of hands, who would buy back into this exact asset?
If you had high conviction.
Okay,
Depending on fundamental side of it.
great. Well, those people would probably be quite smart, because this is Ethereum's chart. This is literally what happened. In fact, the best strategy is do nothing. Right? The best strategy is, if you have high conviction, you do nothing. Don't incur the capital gain, you don't sell the asset, you just hold it for whatever period of time that you have that conviction. If the conviction changes, as you so rightly put, if something that is part of your initial thesis, initial principle changes, then you sell. If nothing changes, you don't sell.
So what you're saying is you're not making your decision based on price. You're making a decision to potentially sell based on material changes.
Totally. I have I don't know where it is, but in this deck, there's a learning that says no one went broke on profit. That's number one. So to all the people that sold, you're also right. You have to sell. The simple fact is you have to sell. But if you have high conviction and there's no other assets, as an investment manager, they expect you to be in asset. So you also are struggling with this emotional decision of whether you stay in asset or you take profit. And most of the time, no one went broke on profit. You've got to take it. Right? You've got to take it. I'll come back to you. So another learning is no new funds under management is dead. If you run a fund that is completely deployed and you find other new investment opportunities, what do? You have to sell assets in order to fund that next purchase. So you've got two options. You trade or you do nothing. If you trade, you need to sell something in order to invest in that new thing. You need to lose conviction or take profit, and that only happens in a bull market. Or lock in losses, right, exactly, or lock in losses. So, what do you do when you have no new fund? You have to find other alternatives to make a profit. The biggest question that we have to ask ourselves is, the most stable, highest growth asset in the portfolio, will the new investment outperform ETH? It's quite simple. It's very, very difficult to justify new investments if you think they're going to outperform, if you think they're going to underperform ETH. If you think ETH has a 10x potential, 5x potential, 10% a year, whatever the growth rate is that you've defined, if you think the asset that you're investing in that's not ETH is not going to outperform in a significant way, then you don't invest. It's really that simple. And this is where we got stuck. So we call this mid-curving. If you think too hard, then you get stuck in this weird middle where you're like, oh, but the intrinsic value is so high and I made this great investment opportunity and I had this pitch and it's all going well and we sold a little bit but then kept the rest and then we bought some more and then it went down, and you're stuck in this middle. Whereas anyone to the right hand side just invests and forgets, and anyone to the left hand side has no idea where they are. Okay, a couple of things that I know you know, but they're worth repeating. It's going to be a quick fire round. Emotions make you a bad investor. Emotions make you a bad investor because your impulse control takes over. It's the same reason that people can't have sweets in the house, otherwise they eat sweets. It's the same reason that if you have a coupon on Uber Eats, you always get pizza. It's the same reasons that you can't control your impulses, and emotions make you a really bad investor. But ignoring them makes you worse. So if you ignore your emotion that says, this sounds too good to be true, I probably shouldn't invest in this, this doesn't feel right. If you ignore those, you will lose more money. It is guaranteed. You do have this innate ability to know what the wrong thing is to do. People often get rushed into deals like, this is completing next week, or you have to, if you're the first 50, you get 50% off, and if you're the next 50, then you only get 40% off. Almost always, as soon as you're being rushed into a deal, the value is coming from you. The worst terms come to you, because great deals require due diligence, great deals require meeting the teams, great deals are not knee-jerk reactions. there will always be a good time to buy. The risk reward is so underrated in this market, and risk reward is really easy to measure. If you're thinking that the amount of risk that you're putting into this investment is either it goes to 1 million or 0, and the reward can be really, really high, irrelevant of what that is, the amount of risk that you're taking is basically 100%. So you're putting all of your eggs in one basket. You can only make a certain amount of those bets with a really small portion of your portfolio, and then that's it. So you always have to think about risk reward in this sense. Don't chase gains. Does anyone know what a revenge trade is? A revenge trade is when you make a bet, you lose the bet, and your next trade is double the amount that it should be because you want to make the money back from the one that you just lost, right? That is a one-way ticket to failure. That's a one-way ticket to liquidity. Being liquidated. That is a horrible, horrible thing to do. Again, emotions make you a really bad trader. This was to your point, and this is to your point. You have to think about your exit and what your exit looks like before you make the investment. Whether it's Ethereum, whether it's Bitcoin, you have to have an understanding of what your exit strategy is. Your exit strategy might be reward-based, so the number that it goes up by. Your exit strategy might be the amount of users that are peaked on the platform, the amount of total value locked, the amount of time that it's taken to appreciate in value. You must have an exit strategy, both for the up and for the down. There is nothing that we hold and nothing that exists that if it goes down below a certain point, you don't get out, right? Then you must have those gates in place. I spoke to someone about paid groups, paid groups most likely a scam, almost all of the time. You're basically acting as the liquidity provider for whales getting out. This is nothing new, something that you should know already. If you don't know what the product is, then you are the product. Patience in our market is really key. Tons of opportunities to buy. The way that we see it, the amount of research that we write on what this market will look like in the next 5, 10, 15 years, $1 trillion is a tiny market cap. $1 trillion is less than 30% of the size of Apple, just one company in the US. $1 trillion for our entire asset class is too small. There will be tons of opportunities. Don't feel rushed, don't feel impatient. Liquidity is the only way that you make money. If you run out of it, it's impossible. And you have to invest. You won't make money sitting on the sidelines. You won't make money if you don't spend time looking at this market. You have to take risk and you have to invest, and it is painful. And you have to invest when it is painful, because when times are really easy, again, with that narrative, you've got a really short window. You better have picked it up in perfect timing, otherwise the only way is down. This one has become more prevalent in the last probably 2 years. No one cared about interest rates 10 years ago, 5 years ago. No one cared about inflation. Now you have to truly understand where you are in the macro cycle. Interest rates have probably peaked in this cycle. Inflation has probably been curved for now, but that doesn't mean that interest rates are going to go back to zero and risk assets are going to get bid. If that happens, inflation is going to skyrocket, interest rates are going to come back up. You have to understand where you are. You don't have to be an economist. You just have to realize the impact on liquidity into a market like ours, because ours are risk assets. And the last thing is, at the end of the day, the only thing people care about is absolute returns. The only thing people care about is how many dollars you make them or how many dollars you make yourself. The way that you judge a good asset manager, the way that if you ever want to invest in an investment firm, whether it's crypto, equities, private equities, something else, you look at their trades. You look at where they actually have made trades and whether those trades are good. Because at the end of the day, the only thing that matters is absolute returns. So what do we do now? I've given you all the shit. How have we evolved? What are some of the learnings? How do we piece that together? We have 4 investment pillars that make it really easy for us to invest. We invest in store of value because it's the biggest, most widely known application to blockchains. We invest in infrastructure because you need infrastructure in order to be able to build companies and build projects. We love DeFi because it's the first thing to be adopted. And we're growing a bigger favour in Web3 and Meta because we feel that if you're looking at adoption, things like gaming, things like NFTs and artwork onboard millions of users that don't care about crypto. And they onboard them through a back end that they might never even realize that they're on blockchain rails. We break down each individual into a taxonomy. So we really deeply try to understand what the project is trying to achieve and where it belongs. That taxonomy is really easy to understand once you piece it together. So whether it's a protocol that is in layer 1 or layer 2, that belongs in infrastructure. What is it actually trying to do? We have an investment methodology and a process. So in our case, when we like something, we identify where it belongs in this category. Then we think about what the core thematic is for that category. So in this case, it's decentralized finance. We then go one layer deeper and say, within decentralized finance, what is it actually trying to achieve? In this case, it's borrowing and lending. Digging one layer deeper, we explore that subcategory and say, what are the assets there that people are actually using? Where are the users driving that value from? We found 3, Aave, Compound, and Maker. And then we go to investment committee with something like a single asset, like Aave. The investment committee is built off a structure. The structure is what we call the 4 T's: team, timing, technology, and tokenomics. There are 2 qualitative and 2 quantitative subjects that you have to cover before you make any investment. And if you're interested, I wrote a 14-page document on exactly how we think about investing across this market. It's a pretty long read, but it's interesting if you want to think like a professional investor, if you want to start piecing together long-term value propositions for your investments. And off the back of some of our learnings with bad trades, we made compliance frameworks. So we built investment memos, we built an investment committee of which one person who is completely outside of crypto sits and tells us that we're complete idiots and we shouldn't be investing in any of these things. We have monthly reviews with that person, and we have sales and exit gates. So we make sure that we understand the strategy before we've even made the investment. And of course, a security policy, because hacks are crazy prevalent. Yes?
Raise your paper and I'd like to read it.
Yeah, I can send it to you. I can send it to you. Sure. Yeah, I can send it to you. I'll send it to Kat and then she can distribute whenever. Okay, and I know you're thinking, well, look, Egor, this is all well and great, right? But you're a professional manager, you're extremely boring, let me do my fun stuff. How would you do that? If I was to do that, you run your total portfolio in a 70-30 split. Your 70% is your low risk, highly concentrated, the slow moving, really boring assets. Your 30% is your random YOLO stuff. Once you make money from your random YOLO stuff, you put 50% of the gain, 50% of the profit into your really boring activities, right? If you do that, it will become incredibly difficult for you to lose money, right? Where people get trapped is they hold on to bags for too long. They hold on to that YOLO stuff. YOLO ends up being 50, 60, 70% of their total portfolio, and then it disappears. That's the biggest issue. People actually never take money out. If you take money out and keep recycling back into your long-term high conviction things, it's very difficult to lose money over the long term. Thank you.
This is not me holding the mic, I'm just kicking off the first question. So, you said that you don't make investments unless they're going to outperform Ethereum. Can you talk to us about a possible investment that you're umming and ahhing about that didn't outperform Ethereum under analysis, but you guys really wanted to go into it, and then you didn't?
And that we didn't go into?
That you didn't, you ended up not going into it, but you wanted to.
We ended up not going into it. It's been a while since we made an investment outside of our What didn't we go into? We didn't go into Maker. So we really liked Maker, especially when they made their switch. The price for Maker was like 900 at the time. I think it's 1,300 now, 1,200, something like that. Someone can correct me. We just couldn't get comfortable with the fact that if Ethereum was successful, if Ethereum was to run, then how does Maker outperform given that the underlying is used on top of the platform, right? For us, it just became an incredibly different value proposition where we couldn't see Maker running higher than Ethereum would in a rate where Bitcoin 5x's, Ethereum 10x's. We could see that Maker would also 10x, and maybe if it goes higher, we wouldn't be able to catch that top. So for a long-term investment thesis, the risk of entering a new asset and having to manage that was not warranted by the value that it could get towards. Does that make sense? So if the market was to run, right now we're in the bear market, it's quite easy, you just don't make that investment because of the risk. Investing in a new asset, if you're thinking Ethereum goes up and alts go up, are you going to catch the precipice upon when that turns and the market turns and everything turns? Are you going to be able to know yourself that you can get out at that top? Because you only have a very small delta. You have a very, very small window and a small delta. And because Maker's already $4 billion total value, $4 billion, someone can find it, it just makes for a really difficult investment process. We run our investment committee in +1 or -1. There's 3 people, so if it's positive, we invest. If it's anything other than positive, you don't invest. Cool. Any other questions?
So your portfolio, do you use the same portfolio management or construction methodology across the entire thing, or do you compartmentalize and use different strategies for different sections of the portfolio?
So we have 4 funds. The first fund is a long multi-asset fund. That portfolio structure is for that flagship fund, that multi-asset fund. The others run a different kind of structure and a different methodology simply because of the way that we shape those funds. There are 2 passive funds which involve no active management, which are taken out. The 2 active funds, one runs that, and it's only that. The other one we've put very, very strict rules around what we can do. So we've put strict rules like no one asset can make up more than 10% of the initial capital value.
Rebalancing kind of thing?
So it's initial capital value. So if 10% turns into 40%, that's fine. It's just that the initial capital value is no more than 10%. We have, and again, we have stage gates for something like that. So if the asset 2x's, we sell 10%. If it 3x's, we sell 20%. 4x's, 40%, something like that. And we recycle those funds. So again, the same degen process that I showed you, we effectively just recycle back into USDC, USDT, and either stake that or use it for a new investment. So otherwise, we run that portfolio, and in that portfolio, we might have, we had a position that started off being like 7% in just one set of NFTs that turned into like 35%, that we then had to go back to the drawing board for and say, this is ridiculous, let's start shaving this. Yeah.
What's your outlook for digital assets?
What's your timeline?
Let's say 3 years.
3 years is going to be
There's a
tough.
bit to happen.
There's a bit to happen. Okay. So everyone thinks that we're going into a bull market immediately after the halving. It's not going to happen. It's probably not going to happen. Just like the most anticipated recession in the macro environment. If everyone thinks that there's going to be a recession, everyone knows for sure there's going to be a recession. It's probably not one coming. It's the same for us. If everyone thinks that the new bull market is starting in 6 months' time, probably not going to happen. So my genuine outlook is there are significant catalysts that you can't ignore. Those catalysts are stabilization of the macro environment, the BlackRock ETF, the halving is definitely one of them, and the failure of the SEC. Now they're starting to be pushed back from Congress. So there's 4 very, very big short-term catalysts. They're 6 to 12-month catalysts. I would say that we will see another, everyone says bull market, we will see another price appreciation period. That period is probably going to last somewhere between 1 and 3 years from now. So it starts 6 to 12 months away, something like that, and continues for a year to maybe 18 months. The problem with these is the higher up we go, the faster and higher up we go, the faster we come back down. I'm a big believer in cycles. We've done a lot of analysis on cycles. The biggest issue with cycles at the moment is cycles are based on on-chain metrics, and the paper markets, so effective derivative markets, have completely outweighed the on-chain metrics. So while the key fundamentals, the people that truly believe in the ecosystem, they don't typically leave their coins on exchanges. They trade as if they've always traded, and that's why 4-year cycles look so transparent. But the derivatives market is infinitely bigger than the on-chain market, and you've just got to watch out for that, because the people that play in that space are ruthless, and they have unlimited capital, and these are the biggest hedge funds in the world. These are the biggest institutions. So unfortunately, I think what's going to happen is it's going to take longer to go up than we want. We're going to go higher than people think, and then the correction is going to be steeper and more aggressive than people expect.
I have one question, maybe not so precise, but how do you think the people AI, the AI we know from 2021, will affect the trades and investment? Because the big people, they got AI 20 years or more. But I'm talking about the AI for people, the mass AI. Do you think it will have impact on trading, decision making, prediction? I know it's not precise.
Yeah, it's a difficult one, but I'm by no means an expert. But if you give 100 people the same amount of information, you're probably going to get to the same outcome. So if everyone has access to the same kind of AI,
everyone understand and using this.
Yeah, and by that same regard, the people that know and understand and use it will completely outweigh the people that don't. And then the more profit that there is, the more people that will come into that space that will be forced to learn and use it. So AI is basically all going to merge into one. There's a finite amount of data, and there's an infinite amount of compute. So eventually all LLMs, all language models are going to merge into one, and then there's going to be very, very little differentiation between the algorithm. There's going to be huge differentiation between the data set. So for everyone using different kinds of AI, it really all depends on the data set, given what inputs that they have. But I don't think it's going to make a particularly big impact to like retail trading, because the big market makers, the big funds, they already use it. It's already used, yeah. Like Wintermute and T-Rock and the third one that I've forgotten. And Jump. Jump build their own architecture. So Jump have their own hardware to do high frequency trading. Like whatever AI competition you think you're going to have, like they just blow you out of the water.
Anyone else?
Yeah.
Talking about time frames, you talked about will adapt and compete.
Yeah.
That's kind of the underlying question.
Yep.
Over what time frame will they have to compete Ethereum?
Over the time frame that you are wanting to sell, buy, liquidate. So you have to have the same parameters. So with basically the theory is all else being equal, do you make the investment or not? For example, you can't put Ethereum and I'll give you one of our investments. We invested in Thorchain, so Rune. We put Thorchain and Rune in the same investment bucket as Ethereum because we think that the long-term viability of a infrastructure for interoperability is needed as long as there's more than one blockchain. So we think that Ethereum is going to outlast all other L1s, and in reality, some sort of interoperability network will also have to last for the same amount of time as Ethereum. Whereas if you wanted to invest in Doge might not have the same lifespan. Doge is a perfectly normal investment strategy as long as you have certain gates of how you want to play that. Doge is basically your alpha on Elon. So if you think that Elon is going to have any impact to crypto, then you should probably have a small allocation to Doge because for some reason he loves Doge.
So in that example of Thor, what time frame did you pick for that comparison?
We're an Everlast fund, so if you had to close your eyes and make an investment for 5 years, then you could do the same on Ethereum, and you weight it based on that principle. So if you have a shorter term play, if you think that something's a little bit more opportunistic in the short term, like maybe a game or GameFi, it would be quite rare to pit that against Ethereum. Also based on the market cap, for Ethereum to 5x is much more difficult than a $50 million market cap coin to 5x. So you have to think about what the total length of your timing is for that.
Sure.
Hey, so this is normally a question I'd ask you over a drink, which we'll probably have in about 10 minutes.
Sure.
Legitimate question, because you referenced YGG.
Yeah.
What does play to earn need to not be a Ponzi scheme?
What does the play to earn need to not be a Ponzi scheme? Okay. Let me answer that question as a gamer. I love gaming. Okay.
Skill, yeah.
So YGG and Axi's biggest issue was that it was a shit game. It was a shit game. Besides the hacks, it was a shit game, right? It wasn't fun to play. People only played it to farm it. I think play to earn as a farming construct is not going anywhere. But I think really high quality games that people want to play that spit out value. Have you ever played Illuvium? It's so complex. It's really, really hard to play. Like, I'm a big game fan, and we have some Yuga assets, and we got distributed the heavy metal game. Also terrible to play, like really boring. But they're building up towards something. Games are incredibly difficult. When I played League of Legends, the game captured you because it was difficult and people were good at it, and you could do so many different things. You couldn't master the game. It's like golf. The reason people play golf is you're never going to be an expert. You could be really, really good at golf, but you're never going to be an expert. You're never going to beat golf. You're never going to beat the game. In Axie, you figured the game out in about 2 days, 3 days. I think Illuvium's going to be really, really difficult. AAA games are really complex, and at the end of the day, it's about users. Initially, you're going to drive users because of this intrinsic value to be able to trade assets and make money from them. But the only way you're going to keep users is if the game's actually really good. There are 20 to 30, maybe even a little bit more AAA rated games coming out next year. Let's just say 30. 25 of them will go to zero. They'll have their hype moments. 25 will go to zero. And 5 will change the way that gaming is done on chain. 5 will change the universe, and 25 will go to zero. But I love gaming. I think it's definitely it's one of our core investment theses. Simply like, anybody played World of Warcraft? Yeah. Okay. So in World of Warcraft. Or Silk Road. Anybody play Silk Road? Probably not. Wow, I'm a loser. In World of Warcraft, you needed gold in order to buy items for your character. The better items you had, the more missions that you could do with your friends. It's a little bit social. In order to get ahead and not spend 400 hours trying to collect gold, you had to buy gold on eBay. On eBay, you had to send money and then find a meeting point with your friend or the guy that was selling it to you in game and have hope to God that he transferred you this gold that you paid real money for, right? All of that goes away, right? You have Immutable that's building in-app wallets through an API. So whether you're playing CSGO, whether you're playing League of Legends, whether you're collecting skins or swords or gold, whatever it is, You have an in-app wallet that is an Ethereum-based wallet that can immediately take those assets out of game for you. You have a marketplace that creates value.
Any questions? Anyone else want to know about with, yes? Yes, Abdul.
Can I have a quick question?
Okay.
Sure.
It's just related to AI. What's your take on the fact that people now have access to the same data set, basically, whether it's ChatGPT or what? So people now have access to the same information. So what impact that we will see in the market just because of that?
What impact will it have on crypto or AI?
Yeah. Well, no, not AI, on crypto.
Honestly, I don't know. I'm not sure. But if you think that all of the scrapers that can scrape every item of the internet, which they already have done multiple times, if all of those data sets are the same, then by virtue the language models are all going to eventually merge into one with a couple of sliders. The difference will be in what context do you want that data output. So are you writing a book and you're trying to find information for the book, or are you a trader that's trying to find alpha? But in reality, you can almost guarantee that you're not going to be the only person in the world that is looking at that one piece of context. And the data is going to be the really important aspect. So it's going to be what data is contextually important to you. So I'll give you an example of how we use it. I'm a big scholar of Howard Marks. I love Howard Marks. I love the way that he thinks. So I gathered all of the data from Howard Marks and maybe 10 other books that I've read and 10 other people and authors. I put it all into a PDF, and I use ChatGPT to say, using this context, and I want it in this language, give me a paragraph or an article, give me advice in this situation. So that's how you can make it contextual. But again, that information is not proprietary. It's all the same. Eventually, it'll all be the same.
How about we scrap all the trading views, charts, and then model it has based on, probability, how to reverse engineer and predict the...
Again, the problem is that everyone's doing the same thing.
Not everyone.
Like, I can't think of an investment strategy that already hasn't been thought of. So if that's what you're punching into the computer to get... Yeah, I don't know is the answer. AI is it's such a green box. I think it will help people's trading, but not individually. I think you have things like Wealthfront that does make certain trades for you based on your tax position. You'll have specific apps that help you cost neutral, for example, or become tax neutral, or they'll have a specific purpose. But making money and generating alpha using AI is going to be pretty difficult.
Okay, so James, sorry, Lindsay, after James, and then question time. We'll close because we are running out of time, but
Sure.
It's been awesome.
This is more of a fundamentals question for you for Ethereum. So how do you reconcile the gas problem for Ethereum, especially when it comes to gaming, right?
L2s.
Yeah, but that's not Ethereum. Like, that's a layer 2 of Ethereum. So, like, how do you see Ethereum solving this problem?
It won't solve the problem. Ethereum's not. It doesn't need to because it has L2s.
Yeah, it's a poor fix.
I don't know. It's pretty good. It works pretty well.
That's like saying, I can't solve it, so let's hope somebody else solves it for us.
I mean, look, sharding's coming, dank sharding's coming, so you'll get to 10,000 TPS. 10,000 will not be enough in 5 or 10 years. So they'll solve it in the short term, but in reality, most of what you actually want to do, you don't need the full security of Ethereum's entire blockchain to do that for you. You can do it on ZK if you want to stay private. There are some things that Ethereum as a base level is just not that good at, and it just doesn't operate the way that it should. For example, if you ever want to put identity, you have to use a layer 2. You will never use native Ethereum because, God forbid, if you lose if you lose your key, you lose your identity, you lose your privacy, or if someone hacks you and steals your entire identity, it's going to be really difficult. If you go to the dentist and you sign on the Ethereum blockchain, they'll be able to see all your history and all your... So there are things that L2s are going to be really, really good at. And in fact, what you'll see moving forward is, like Lord of the Rings, one chain to rule them all. And then you'll have app-specific or, in fact, industry-specific L2s that serve one intended purpose. And then you'll have bridges across the board all over the place. So it will be really, moving forward, it'll be really easy to bridge between one L2 to the other. And in fact, most of the users, they will have no idea that they're using an L2.
So James Lindsay, final question, and then
So in terms of AI, for those that was you that were asking, from a security point of view, it really depends on the person that's using it and how you engineer your questions to get what you want. So if you're going to engineer questions to say, hey, I want information on this blockchain versus this is what I want, can you tell me how to exploit it, and then kind of like engineer your way into it. It really is on the person that's using it, not the AI itself.
Where have you been while I've been answering all the AI questions? You're here suffering and barely know anything about AI.
This is Lindsay, she's a cybersecurity expert.
Excellent. I did my thesis in cybersecurity.
Oh, terrific. More things to talk about after this. Ladies and gentlemen,
Great.
give it up.
Thank you guys, appreciate it.
That was so much fun. Let's keep talking about that over drinks. Okay.